is relatively straightforward. Specific identification is definitely straightforward. Look at B on page 185. Review all of the examples that they've given you just so that you're comfortable with the different methods. Okay? Definitely know on page 186 the lower of cost or market. Remember that you're going to compare cost to market. But market is either the replacement cost, it's either the net realizable value, or it's the net realizable value less normal profit, whichever one of those three numbers falls in the middle. Okay? Now, also what I want you to know is dollar value LIFO as it's given on page 187. So know how to do dollar value LIFO, and by all means go through this example that they give you in Wiley. I think it's a pretty clear example. Page 189, I wouldn't worry too much about the link chain technique, but you should be familiar at the bottom of 189 with the gross profit method. Okay? No consignments on page 190. You are going to be asked about that. Also know the difference between FOB shipping point and FOB destination. And then, as I mentioned to you, you do need to know about the completed contract and the percentage of completion methods. Very important. All right? So, good luck with these. And maybe I have time to do a problem right now, so let me do a problem. I have 8 minutes, so let's do some problems. The more problems that we do, the better. So, these problems are going to start on page 195 at the end of Wiley. And problem number 1. Let's start with some easy ones first. The following information applies to Fenn for 2008. So they give us all of these different costs, and they want to know Fenn's 2008 inventoriable cost will be. Well, now, see again, what they're testing you on is whether you know what items should be included in your inventory costs and what items should not be. Well, in this particular case, the merchandise purchased for resale should be included. So that's $400,000. So our purchases should be included, $400,000. We also know that freight in should be included. Freight in. Because that's the cost of getting the inventory into our store. Freight out should not be included. Why? Because freight out is the cost of it's a selling expense. It's what we pay to deliver the merchandise to our customers. So that's a selling expense and would not be included. And purchase returns would be included. All right, so purchase returns would be included. And they would be subtracted because that's inventory that we returned. So 400 plus 410 minus 2,000 would give us $408,000. So our answer is going to be C. Okay? Now, let's look at item number 2. On December 28th, 2008, Kerr Manufacturing purchased goods costing $50,000. The terms were FOB destination. What does that mean? Remember, FOB destination is that the seller inventories the cost of the goods in transit until they actually reach the buyer. So, some of the costs incurred in connection with the sale and delivery. Packaging for shipment, shipping, special handling charges. These goods were received on December 31st, 2008. Incurs December 31st, 2008 balance sheet. What amount of cost for these goods should be included in inventory? Okay. Now, here is the point about this question. The inventory should not purchase goods on December 28th, Kerr purchased goods. So we're accounting from the point of view of Kerr. The terms were FOB destination and some of the costs incurred. These goods were received on December 31st. So the goods were received, so now the $50,000 of the goods, since they have received the destination Kerr, that should be included. The packaging for shipment should be included. So we've got 50,000. We've got packaging for shipment, 1,000. We've got special handling, which is 2,000. And we've got the other charge. So the total is 54,500. All right, but now let's go back and read what this problem says. Again, number 2, it says the terms were FOB destination. So wait a second. The only thing that Kerr needs to include in its inventory is the $50,000 cost of the inventory. It does not need to include these shipping costs since it's FOB destination. Now let me just say this. If perhaps this would have been FOB shipping point, then the answer would have been 54,500. But for number 2, our answer is D, 50,000, because it's FOB destination. All right, last one. Let's do problem number 8. Problem number 8, the following information pertain to Azure Company for the year. It says, what amount should Azure report as cost of goods sold for the year? Okay, so now we go back to that formula that I used before. Okay, so we have purchases, we have beginning inventory of 30,840. Okay, then we go to net purchases. And net purchases equals our purchases 102,800 minus our purchase discounts, which is 10,280, minus any purchase returns or allowances. So we don't have that, okay? That's our net purchases. And then we have freight in. And our freight in is going to be 15,420. So we add these three things together, and that's going to give us what our costs of goods available for sale are. So cost of goods available should be, this is 30, that's 98, that should be 138,780. 138,780. Okay? Now, what they ask us, what do they tell us? They tell us that our ending inventory is 20,560. So ending is 20,560. So that our cost of goods sold is going to be 118,220, which is B. 118,220, which is B. So that brings us to the end of this module, or this portion of the module. When we come back, we'll do some more problems. See you in a little bit.